Hello, Stephanie Anderson and I'm Carolyn Kadaj. We are here to talk to you about how to reduce high W-2 wages. So, this is general information. It's not specific to your situation, though. We can talk about how to make that specific for your situation. You can go on, Stephanie.
Sure. It may be, the end of July or start of August, but there is still time to make a meaningful impact in your tax liability for 2026. Pro
Woohoo!
Yeah, I know most people wait until the following year when it's tax time to try to find tax savings. But once you wait and the year is closed, all your financial reporting is in cement. There's very little that we could do. Right now is a window of opportunity to make a large impact in this year's tax savings.
Uh,
Okay.
you can talk about this if you want to.
Yeah, this is just saying that, tax planning is all facts and circumstances specific to that particular taxpayer, which is why we have to ask a lot of questions before we recommend any tax strategies. So this is just a general educational video. It is not specific to you, and you cannot rely on it for your doing your own taxes.
So a high W-2 earner can slash their tax bill three different ways. And we'll go through them. Click on the next slide. So the problem here is that with a business or even a rental, there are specific deductions. There's a depreciation deduction. You could even in some circumstances write off mileage. But there's with a W-2, there's not really a lot unless you itemize. That could There's some deductions there. There's some deductions maybe if you put money into an HSA. But really the W-2 wage earner is stuck. So what's what a lot of people don't realize is that the US tax code spans more than 70,000 pages and only 10% define what you owe. And then there 90% talk about opportunity to possibly not owe as much. I like to help people remember that who makes the law? Congress makes the law. And what do Congress like to do? Well, they like to create laws that they personally would benefit from. And what's cool about that is that anything that is in law for congressmen and women is also law for anyone else too, as long as they qualify. So the with high W-2 wage earners, as a general rule, the federal, depending on the levels, of course, but the federal amount can go up to 37%. And then you have the net investment income tax, which basically is an additional tax on for the more wealthy of 3.8%. So it gets to the end, especially if you live in California, people are spending at least half of their salary on taxes. And that doesn't have to be the end result.
Very well said. So, yeah, how the tax code started was by saying that everything was taxable income. And then through primary source citation, treasury regulations, tax court cases, all sorts of things, basically explain what are exceptions to what is taxable income. So aligning your facts and circumstances and hitting the mark on what it says in that primary source citation is how you know if something is legal or not legal. Okay, well, strategy number one, I think most people know already, which is to maximize your deferred retirement contributions, right? If you're getting a W-2 paycheck, you may have the option to participate in the retirement plan. And most people are doing this, and it's super easy. There's like virtually no work involved, but you are kicking the can down the road. So what happens with this is that it reduces your taxable income in this particular tax year when you make that tax deferred contribution. But down the road, you will have RMDs, required minimum distributions, and you'll be required to take a certain percentage out every year. So you can get, some pleasure right now by putting money in there, but then you create a rather complex tax planning situation through your 60s and 70s, which we're well equipped to deal with, of course. And something to consider if you have a lot in your 401k right now, depending on your age, we want to consider and look at a backdoor Roth or mega backdoor Roth and see if we can't lower those RMDs in the future, which have everything to do with how much Medicare premiums you will be paying, and you will have less opportunity in retirement for tax planning.
So the short-term rental tax loophole, uh, in a way, it's you can have your cake and eat it too. You can earn your W-2 job, and you can you can have a rental property where you're benefiting with tax deductions, and those tax deductions can offset the W-2 income. Go on. So there's a few ways to do this, and um, w- w- part of it is ensuring that it's classified correctly and making sure you qualify. So we want to make sure it's not passive activity. Typically, rental income is passive activity, but if you're active, then you can offset the losses of the rental can offset the active income of your W-2. So ways to be active: a guest stays in the property 7 days or less. Another piece is ensuring that you have the documentation set up correctly, it's reported correctly, and I want to mention that the real estate professional status is not required. That is another way to make it active, but for the short-term rental strategy, the real estate professional status is not required. So, Stephanie, if you don't mind, go to the next slide. So, ways to make the test. You need to spend at least 100 hours doing management type activity of the property. And this is one of the most scrutinized areas by the IRS if you were to be audited. One of the things that we help our clients do is ensure they're set up for success so that the reporting is correct and that the IRS is happy. The Another layer to that, in addition to the 100 hours, 100 hours and spending more time than anyone else managing the property. So both of those together. The next piece would be doing a cost segregation study to ensure that you have more deductions, uh, more like front load the deductions instead of spanning them out over time. Uh, with in conjunction with the cost segregation study, we'd also use bonus, and they are used in conjunction, but they are a bit different animals, but they're used simultaneously. So, as a result, a $500,000 short-term rental can generate 150 to 200,000 in year one alone. And making sure everything is documented is certainly key for the strategy.
Wonderful.
So I just want to introduce the accredited investor strategies. Stephanie and I spent a lot of time in these, and a lot of our clients are have benefited from these. So think of leveraging your money so that you're not just paying your taxes. Well, we talked about 50% previously. You're not just paying taxes, but you're maybe investing, moving that money instead of paying to the IRS or the state, moving it into an investment that also creates a deduction. Um, then go to the next slide, please. So there are two ways to qualify for an accredited investor. One is the income. If you are married, filing joint, the threshold we'd be looking at is 300,000. If you're single or married, filing separate, the threshold we'd be looking at is 200,000. So if you have that amount of income for the last 2 consecutive years and you have that at least for the foreseeable future in the current year, you qualify. The next step test is if your net worth is over $1 million. In We do not look at your primary residence, but anything beyond your primary residence, such as stocks and 401k and other rental properties. If all of those are more than $1 million together, then you do qualify.
Very well said. So
All right,
we,
so go
go
ahead,
ahead.
Stephanie, with some examples.
Okay. Yeah, so we have a plethora of accredited investor strategies. We are not going to share all of those today. And what we do again is when we work with somebody, we figure out their facts and circumstances, we understand their long-term goals, and we find the strategies that align with that. So we're going to share today just one example, which is oil and gas. This has a high tax confidence level. It's been around for 80 years and it's super easy, super, super easy. So for example, we know there are a lot of oil drills and wells in the Permian Basin of Texas, right? So what would happen is you would become an investor in one of those. And there are inherent tax attributes that make this positive for the taxpayer. So in year one, you get something called an IDC deduction, which is intangible drilling costs, and it depends on which investment that you get into. It can range from 80 to 92% of your investment. That becomes a deduction in year one. Now, a deduction is not dollar for dollar, right? Credits are dollar for dollar. A deduction, you would take that amount and multiply it by your effective tax rate to understand how much tax savings is available. And of course, we do that math for you and share it with you. Now, ideally, that drill is going to cash flow for the subsequent years, and you will have income coming in that is subject to tax. However, there's another attribute of this, which is called the depletion allowance, so that when that comes in, it's automatically reduced by 15% for the depletion allowance. And the third wonderful attribute is that it's not subject to NIIT. Have you ever looked at your tax return to see how much you are you're paying on that? Usually high income W-2 wage earners have additional taxes, such as the 3.8% and the additional Medicare. So and this could be a powerful thing that brings you down to another threshold to reduce, additional Medicare and NIIT. So you want to take a look at how all of this flows together and understand the ultimate financial result that you could reasonably expect from this investment. So this is a wonderful, easy thing to do, and a lot of our clients do it year in and year out. Carolyn, do you want me to do this one?
Yeah, you can go through all the examples.
Okay, great. So there's other things that are private offerings, right? Where private offerings where you get ownership in certain entities. And what happens is you will get a pass through on your 1040 through a K1, right? So you can see there's different types of pass through entities. And you can pull down a negative number on your tax return. There are so many complexities with this that we're not going to take the time today to go through them. There's, different levels of ownership, there's basis, there's debt, whether you can take debt basis. You don't need to concern yourself with that. You just need to know that this is something available to you, and to work with people like me and Carolyn who study this day in and day out and help our clients through. The point is to let you know that there are options. So let's take a look at the clean energy example. Um, Earlier, I mentioned that deductions are not dollar for dollar, right? You take the amount of your deduction, you multiply it by your effective tax rate to understand what your tax savings. Well, a credit is dollar for dollar. It's so there's a 30% tax credit involved with solar investments. These can be commercial solar investments. We're not talking about on your personal home. These are large commercial type activities. So you could be one of many investors who will pass through with your portion of this solar tax credit. And this is just some example of that. You obviously were not suggesting do the whole solar project you're on your own for 10 million, but you could be one of many in this particular thing. So here's an example. If you invested $100 in this large project, you would have an 80% credit, right? That flows through into your return. That's the same as putting $80,000 payment on your tax return. And we will show you, how all the math works out. Oh, there's a fourth bonus strategy. Ellen?
Bonus. If only we had the like a bow, 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 like super cool sound effects, but we have a bonus strategy. So we talked about short-term rentals. And a lot of times people think about, oh yeah, my Airbnb. Oh yeah, there I can get a property down the road. But what if you could do the same thing but with a hotel? So it deserves its own category because most people just don't think about it. And so by default, hotels, people stay 7 days or less. And what what makes this strategy powerful is that you not only just have the building, but you have the beds, the furniture, the lampstands, you have all of the things that can be depreciated within 5 to 7 years. So you get a pretty large deduction for them very quickly. And cost segregation, we talked about that previously, but we would be able to help accelerate the depreciation of all of the pieces, not moving pieces, hopefully. But what I didn't do earlier, the cost is to define a cost segregation study. So typically a rental home, it would be 27 and a half years. Residential rental. A hotel is 39 years. You don't necessarily need to know all of this. Um, but just to give you help you understand it, each every building has their own system. You have your electrical system, you have your water system, HVAC system, and they compartmentalize each of the systems to um, separately so that we'll say HVAC might be 7 years or 7 to 10 years instead of the larger 27 and a half or 39. So this means that you can take the deduction for what's eligible sooner. So I didn't talk about what a cost segregation study is, but a cost segregation and accelerated depreciation are both eligible on hotels. So if you happen to purchase a hotel, uh, in the end, it just means a larger amount of deduction available to you.
Absolutely. this is an easy win. And I've worked with some extremely affluent people who do this a lot. The numbers are so powerful. And I understand, we're in California and Southern California hotels are definitely out of my price range. But there are other areas of the country where this is possible. And, it's a real nice one to consider. Just take a look out there. The other thing I want to say about cost segregation studies is there's a lot of misinformation on the internet, and you want to make sure that you're getting your cost segregation study from a vetted company. You want to understand how many audits those reports have already been through, what's the reputation of that company. These are all really important things because they should be performed by an underlying engineer. It's really, really important to not cheap out on the cost segregation study. In addition, you want to consider how long you're going to own that property, right? Because there could be recapture of depreciation at ordinary income rates. So this is for long-term holdings we would recommend, and we could talk about that in detail with you. And it the tax technical side of that is this property already placed in service on your tax return? Do you have an established asset listing for this property where you've reported, around 2 years already? Then we can't just arbitrarily change that depreciation schedule. There would have to be an accounting change, which is tax technical. I personally love doing those packets. It is fun. So you have to have your work papers, and it's very, very detail oriented math. I love it. But just be aware, there are some nuances and some details and some technicalities that you must take quite seriously for this to hold up under IRS scrutiny. But if you do all these things right, you will pay significantly less tax. That's real. Oh, Carolyn, what does it mean to get a personalized tax assessment?
Personalized tax assessment is cult I'm going to say cultivating or crafting a plan specific to you, our client, and the specific facts and circumstances. So once we determine that you qualify for the tax assessment, we'll look at the income. That's important, but we'll also look at your assets and your goals. We'll learn about your fears and present the strategies for you that would make a big difference on your tax bill. So we do those assessments for 2497. If you qualify, we'll do that. And one of the things we guarantee, if we can save you at least 3x that amount, um, sorry, let me say it differently. We guarantee we'll save you at least 3x that amount. So at least 10,000. If we don't, we'll refund your 2497, no questions asked.
And that's in the identification of opportunity, correct?
Right. That is correct. And the tax assessment, whatever you pay for the tax assessment will go toward the annual program. If you decide you want us to help you implement these strategies, not just identify which ones are best for you, we will apply that investment toward the annual program.
Perfect. Wonderful.